All right, everyone, welcome back for a special edition here of Carnivore Trades. Going to do a little bit of long-term cyclical work here. This is kind of a follow-up video to a video I did last June on gold and long-term price projections and essentially my outlook at the time. And I rewatched that recently, and the recent action in gold kind of made me want to rewatch that and see kind of where I was and review essentially my calls. And for a while I thought I was wrong with my initial calls in that video, at least most of them. But rewatching it, a lot of it was spot on. Some of it maybe it may have gotten a little bit ahead of itself. I think I called for 2,700 uh, spot gold price in 18 months, and that was June. So that would be by the um, end of this year, which is not impossible. I mean, it's certainly not impossible. It could easily get there. I mean, we got up to almost 2,100 a week or two ago. So if we push through it, it's still on the table. But one of the things I did really get correct was yields in gold going up the same time. So typically the thought process is yields up, gold down. And I said that that's not, that is generally the case, but it's not always the case. So when you have yields going up because of growth, it's very important to make this distinction. And it's the same thing that I pounded and pounded and pounded the table on last year. And everybody was saying, oh, the Nasdaq's going to go to 18,000, SPX is going to 5,500, the Russell 2000 is going, because yields are going to go up, and and that means risk on. Well, it's not that simple. Bonds, like stocks, move up for different reasons. There's more than one dynamic that moves asset prices. So if yields are moving up because of growth, that is a risk on signal. If they're moving up because of inflation, that is risk off. Hence why a risk off asset like gold can move higher with yields. When did gold bottom? August 2021. 10-year treasury yield bottomed in August 2021. Little dip there in July, kind of double bottom there. Dollar index, that's supposed to trade inverse to gold, right? And that bottomed in June and went higher along with gold and yields all year. So that was something I definitely pretty much hit nail on the head. And another thing, which is really the main point of the video that we're going to kind of get into, and this video is mainly about gold, but we're going to talk about equities too and oil a little bit, because essentially I think we're about to repeat a 2008, and I don't say that lightly. Last year I did another kind of video like this projecting a bear market for 2022, using some Fibonacci cycles, advanced cycles, cycle work that I do. And a lot of people said, a lot of people liked it, but there were some people who were saying like, that's impossible. The Fed has outlawed bear markets. You spy every dip. That'll never happen again. And things change really fast, don't they? I mean, we look at where we were in, 3 months ago, and now everybody's, the sky is falling essentially. So things can change very quickly. But if you haven't watched that video on gold that I did, I'm going to put the link in the description. Make sure you check that out before you finish this one, because it's going to preface everything and give you a little bit more of a background. But let's just get into it here. So gold, essentially one of the main points I made in that video was there's two kind of cycles. There's really part of the same cycle, but there's two potential areas that I think we are in this kind of cyclical bull market. So if you just go to the 1999 low and just take a fib right to the 2008 high, you get a perfect 382 retrace, perfect back test of this breakout from 2006, 2007, nice consolidation. Great technical pattern here, perfect, right? And then you get a big super cycle. So the debate I was kind of having with myself was, is this kind of the cycle we're in here? So if we look at where we are now, we have this move up and then a big steep pullback, but it's not this was more of a crash pullback, right? So it was kind of sideways, and then you crash down at the end. This is more of a kind of controlled, just grinding type pullback. So the question was, is this the cycle we're in, or are we in the 2006 to 2007 cycle? And let me show you the striking similarities there as well. So just take the same fib and just pull it right down. You get a perfect 382. So you get the 382 both times, and this is kind of you got a little small consolidation chop there that kind of acts as what this was to this part here. But you got, the 382 is very prevalent, right? That's the important part. Now I'm going to tell you why I think we're possibly right here. So we put in this consolidation pattern 06, 07. I wasn't trading back then. I wonder what sentiment was like. I wonder if it was anything like it was here, where basically everybody made gold a laughing stock for quite a while. And, I was myself and a few others were saying, this is just a one big pullback pattern. That's really all it is. It's no different than any sort of consolidation pattern. And by the way, all this giant move up here was probably pricing in the inflation we're seeing now. And the pullback is it's possibly projecting some disinflation that may happen. And why is that? Well, again, so we broke out here in September of 2007. Let's take a look at the spiders, S&P 500. What was that doing in 2007 in September? Oh, it was just topping out a month later in October. So gold is breaking out as the spiders were topping out. So, I mean, okay, whatever. That's just one little silly correlation, right? Let's look at oil, though. So what does oil do? We have this kind of pretty steep decline here from 06 to 07, and then just a run up. And here's October, blast off higher. Look at the size of that bar. So this is when gold is breaking out. This is when the spiders were topping. The Nasdaq was topping. And what is energy doing? It's just going higher for about, 6, 7, 8 months before it finally topped out. Demand destruction, probably margin selling from equity traders causing, selling in crude. Also, what else was it causing selling in? Oh, gold, of course. So gold tops out here, and then you get margins. You get this big margin selling breakdown here. And then it turns around and becomes a super cycle. So what do we have here? Let's just go on a weekly. You can see it a little bit better. So when does gold start breaking out? Middle of January, February? When do the spiders start topping out? Right at the beginning of January. Okay. When does the Nasdaq top out? November 22nd. Crude starts breaking out the week of November 20th. And it was moving higher before, but it really started to push then. We go back to 2008 again. We had a big crash. Oh, look, a big crash, and then a run up, and then another powerful blow off top here. Now, typically, historically, we talked about the spiders recently, but it's more prevalent with the triple Qs. Seen the triple Qs top out sharply in October here, but when money leaves tech, a lot of the time, and I've mentioned this several times recently, a lot of the time it will go into energy. So money leaving tech tends to head into energy stocks. If you look at the XLE, how's that performed? Very, very well. So this is moving higher while tech is moving lower. And, stocks in general moving lower. Energy's moving higher. Gold's moving higher. So there's similarities right there. What do we have now? We have really bad commodity inflation. Copper, wheat. I don't need to go down the list here, but what does insanely high commodity prices and insanely high inflation lead to? It leads to a bust cycle. It leads to demand destruction. What happened in 2008 when oil hit $150 a barrel? We had major demand destruction, and we went into recession and ultimately the GFC. What we're seeing here is very similar. It's very similar. So if we're right here, and this is September, and we're, pushing, there's no guarantee. It's not going to be exact, And again, this could fail. It could, come back down and we just consolidate for a while, or, something else happens. But if this does break out here, sometime in the next, several months and pushes higher, there's nothing to say that gold doesn't go to 4,000 within the next 24 months. And you might say, well, that's way too much. It's not going to double from here. Well, people said it was crazy when I called for a bear market in 2022, and even crazier when I went short on December 31st, 2021, just 2 days before the actual markets topped. This is all just using the same cycle work that I rely on, and it works very well for me. But in any case, how does it get to 4,000? Well, you go from 700 here, your breakout area, and you went up to, just above 1,000, and then you pulled back to 682, you got back up here, and essentially you doubled. You went from 1,000 to 2,000. So if we pushed back, if we broke out here and then came down again, and basically we'd be back testing this 2,000 area, right? There's not, I mean, 2,000 or 4,000 is actually conservative if you think about it. Because if this is back testing this breakout, then that means we'd be back testing, in the future somewhere around here, around 2,000. And you went from 700 up to basically 2,000 an ounce from 09 to 2011. So that's actually more than 2x. So really 4,000 is actually pretty conservative. And again, it sounds like a dramatic move, but it is. This was a dramatic move, but it happened. So by saying a move to 4,000 can happen, I'm not suggesting anything that hasn't already happened in past cycles, especially if you consider continued geopolitical issues. If we have a Fed that's boxed in, we have a Fed that can't even, I mean, this is the first time since, everybody says like, well, the Fed is going to, the Fed can just come in and save the markets. This is the first time since the 70s or really 1980 that the Fed has had to deal with headline CPI at 8%. They've had the luxury of the last 13 years of having 2% or less CPI. Now, yeah, I'm not here to debate what the actual inflation rate is. We all know it's not the same as what the headline number is. But the point is they could lean on that headline CPI number, and the inflation may have been higher than 2%, but it wasn't out of control like it is now. So we don't know how the Fed's going to respond. We don't know we don't know what they're going to do. And we don't know if they're going to make really bad mistakes. And if that does happen, all of these things I'm talking about are good for gold. Why? Uncertainty, fear, monetary issues, lack of confidence, geopolitical issues, war, currency problems. So it's absolutely not even far-fetched at all to think that in the next 24 months, and I'm giving it 2 years here, to double. So it went, 2009 to mid 2011, or well, end of 2008 to mid 2011, it more than doubled, went from 700 to 2,000. It's almost tripling. That's 2.82, I think, X. So, we could get up to 5,000 by 2024. I'm just, hypothesizing. I'm not saying it happens, but I can see the possibility for it. And here's the case of how it can happen. So we'll see if later this year, maybe my 2,700 price target ends up panning out by the end of this year. It's certainly possible. And I think when I made that call, I didn't even really realize how accurate it was. In fact, I can tell you, I didn't even realize how accurate it was going to be. Assuming this all plays out, right? Again, it could fail. All these patterns that have repeated themselves over and over and over throughout time could fail, and they could just stop working all of a sudden. By the way, speaking of patterns that repeat, take a look at 99, the bottom here, and then into 2006. Doesn't that look kind of familiar? It's a little sharp of a decline, but doesn't that look kind of like 2015? Nice power move off the lows, then a couple higher lows, and then a thrust higher. Power move, higher lows. People hated gold back then. and they hated gold in 2015. I mean, these patterns just repeat themselves over and over, and that's all assets, you know, all stocks, bonds, commodities, forex, crypto, anything you can think of under the sun. It's all just human nature, and these patterns will repeat over and over, and it really until the end of time. But anyways, just wanted to wrap that up there. So essentially, obviously, what I'm saying is, you know, the fundamental case for gold over the next couple of years remains very strong. That doesn't mean now, if you know, keep in mind, if I'm right about all of this, we're going to have a big drawdown, you know, sometime probably late this year or early next year. And, you know, it's going to draw down pretty hard, just like it did in 2008. So it's not going to be all straight up, but, you know, that's something on the table. And essentially what I'd be projecting by saying that is that we'd have probably a major collapse in crude, and we'd probably have a continued bear in equities, which is something I already expected anyway. But again, nothing goes down in a straight line. It's not going to go in a straight line, but you know, this is your kind of mean, right? This is the mean, and we have to revert to the mean. You know, you look at the long-term trend here on equities. If that's your mean right here, you know, somewhere along this line, that's, you know, we got a little ways to go still just to even get there. And a lot of the time, you know, credit default swaps, there's whispers of that coming back up now. Broker dealer, high yield debt. Take a look at high yield debt. That's not looking healthy at all. You know, LQD, broker dealers, this has got to hold this area. Otherwise, this goes back to 300. So there's lots of problems under the hood. And I could definitely see some type of a bear followed by a crash, which usually happens at the end of bear markets. Usually bear markets are a grind, which is exactly what we've seen so far. But again, nothing goes down in a straight line, and there will be big bounces along the way. Anyways, I'm going to wrap it up here. Hope everybody enjoyed it. Hope it's made everybody think a little bit. Again, not saying that, you know, I'm right about anything here. This is just the work I've, you know, put in and some of the studies that I've done. Give me some feedback. Let me know if you love it, you hate it. I'm an idiot. I'm awesome, whatever. Come find me on carnivoretrades.com if you're interested in swing trading. Just put out a course. It's absolutely phenomenal. Almost 5 hours of material in it. Pretty much everything I know about methodology and everything I look for in chart setup, the best patterns, best ones I trade, best methodology factors, how to stack them all together to create the highest probability trade. Anyways, guys, I'm going to wrap it up here. You guys have a great rest of your night, and I will talk to you all later.